stop scrolling, because what's happening to silver in China right now is something most investors have never seen before. While headlines in the West stay quiet, silver in China is trading near $80 an ounce, and that's not a typo. This isn't a normal price move. This is a premium explosion. And historically, when premiums detach this violently from global spot prices, it signals one thing: pressure building behind the scenes. Here's why this matters. China is one of the world's largest silver consumers. Solar panels, electronics, industrial demand. And when Chinese buyers are willing to pay massive premiums, it means physical supply is tightening fast. Paper prices might say one thing, but real metal tells a very different story. This is exactly how squeezes begin. First, the premiums blow out, then inventories drain, then suddenly the market gaps higher when nobody expects it. And the timing couldn't be more critical. Global silver inventories are already stretched. Industrial demand keeps rising. Investment demand is quietly returning. Meanwhile, arbitrage routes are breaking down and banks are struggling to move metal where it's needed most. When physical silver becomes scarce, futures markets don't stay calm for long. If this disconnect closes violently, we could be looking at one of the most aggressive silver repricings in years. The question isn't if the pressure releases, it's how fast. If you want to understand what this premium explosion really means, how a silver squeeze could unfold, and why China might be the trigger the market isn't pricing in yet, stay with me, because this is something every silver watcher needs to see. If you find this breakdown valuable, hit the like button. It helps the channel and tells me to bring you more real-time silver insights. Disclaimer: this video is for educational and informational purposes only, and does not constitute financial or investment advice. I am not a financial advisor. Always do your own research and consult a qualified professional before making any investment decisions. Stop scrolling, because what is happening to silver in China right now is unlike anything most investors have seen in years. While headlines in the West remain quiet, silver in China is trading near $80 an ounce. And that number is not just a statistic, it's a warning signal. This isn't normal market behavior. This is a premium explosion. And for anyone who understands the difference between paper prices and physical reality, it screams of squeeze potential. Let's start with the fundamentals. China is not a marginal player in the silver market. It's one of the world's largest consumers of industrial silver used in solar panels, electronics, batteries, and medical equipment. These are not optional purchases. They are critical inputs to ongoing production. When Chinese buyers are willing to pay extreme premiums over global spot prices, it indicates immediate scarcity in physical silver. Paper prices, which many investors rely on, reflect expectations and liquidity. But Shanghai's physical premiums reveal the real stress in the supply chain. Think about it like this. Markets are supposed to balance. If silver costs $25 in one location and $30 in another, arbitrage exists. Traders buy low, sell high, and prices converge. But right now, those mechanisms are failing. Physical silver cannot move fast enough to close the gap. Vaults are constrained, refineries are operating at capacity, shipping is delayed, and regulatory friction is slowing cross-border flows. Banks, which normally facilitate arbitrage, are finding themselves squeezed themselves, caught between obligations and limited availability. This is the precursor to what smart investors call a physical squeeze. Unlike a speculative rally, this is not driven by sentiment or social media hype. It is driven by real scarcity, real consumption, and structural market constraints. Premiums are a leading indicator. When they blow out like they are right now in China, futures prices are often weeks or months behind. That's why this matters more than headlines. It's where the market is about to move. Now, consider inventories. Above-ground silver stocks globally have been slowly declining for years. They were once abundant enough to smooth fluctuations in industrial demand, but now they are being drawn down faster than replenishment. Mines are not able to supply enough metal, primarily because most silver comes as a byproduct of base metal mining. Even if prices rise, production cannot spike overnight. That structural lag is precisely what causes premiums to blow out in physical markets. Industrial demand is relentless. Solar energy alone consumes hundreds of millions of ounces annually. Electronics require precise quantities, and medical applications are growing as technology advances. Factories cannot stop production. They must secure supply at whatever cost. And that is exactly what we are seeing, reflected in Chinese premiums. It's not panic buying, it's necessity. When necessity intersects with scarcity, prices move quickly, sometimes violently. Historically, we've seen similar patterns. Palladium in 2020, silver in 2011, physical shortages preceded explosive price moves by weeks. Investors who relied solely on paper markets missed the early signals because they were looking at lagging data. Physical premiums, delivery times, and inventory reports were flashing red long before the market reacted. The same pattern is forming now. Arbitrage breakdown is another critical factor. Normally, differences between markets are temporary. Traders exploit them, moving metal to where it's scarce, but friction in shipping, regulatory delays, and strategic stockpiling have created barriers. This is why Shanghai's premium is not simply noise, it's a signal. The system is under tension, and markets will eventually reconcile physical and paper reality. Now, let's talk about timing and leverage. Silver is not like gold. Gold has deep above-ground reserves and a slower industrial consumption rate. Silver's lower above-ground stocks relative to demand make it more sensitive to shocks. When physical scarcity meets leveraged positions in futures, the effect can be exponentially amplified. A relatively small reduction in available metal can cascade into massive price swings. Think of it as a spring wound tightly. A small nudge releases tremendous energy. Banks and bullion dealers play a stabilizing role under normal circumstances. They smooth out minor imbalances, ensure deliveries, and facilitate arbitrage. But when multiple institutions face the same shortages simultaneously, the system becomes stressed. Short positions turn into liabilities, delivery obligations become urgent, and risk management shifts from profit maximization to system preservation. That's when the market's calm facade disappears. Investors need to watch more than just the COMEX chart. Prices alone are misleading during a physical squeeze. What matters are premiums, inventory levels, delivery delays, and structural bottlenecks. These are the pressure gauges of a market under stress, and right now those gauges are flashing for silver in China. Finally, there's the psychological aspect. When traders see premiums rising dramatically, behavior changes. Speculators tighten positions, hedgers adjust risk, and investors reallocate capital. This feedback loop amplifies initial pressure, accelerating the market's response. What may look like a sudden spike is actually the culmination of weeks or months of unseen structural stress. Understanding these dynamics is essential. The $80 silver premium is not just a number. It is a signal of imbalance, scarcity, and imminent repricing. For intelligent investors, it offers insight into where the market is heading before mainstream headlines catch up. By observing physical flows, industrial consumption, and logistical stress, one can anticipate movements far earlier than relying on charts alone. The stage is set. Physical demand is outpacing supply. Premiums are blowing out, inventories are tight, and arbitrage is breaking down. The market is under structural stress, and when resolution occurs, it is likely to be fast, dramatic, and consequential. Those prepared with insight into physical pressures, supply chain constraints, and global industrial demand will be positioned to understand the true magnitude of the coming moves. Let's dive deeper into the mechanics that are creating this unprecedented tension in the silver market. Understanding the arbitrage dynamics is critical because they are what usually prevent premiums from exploding. In a normal environment, any disparity between markets is corrected quickly. If Shanghai silver is trading at $80 and COMEX is at a lower price, traders buy physical metal where it is cheaper, transport it, and sell it where it's more expensive. That movement equalizes the price. It is the lifeblood of global commodity markets. But right now, this mechanism is under extraordinary stress. Physical silver cannot move freely due to multiple factors. Logistical bottlenecks in shipping, restricted availability in refineries, customs and regulatory friction, and strategic stockpiling by industrial users are all limiting the flow. This is what allows Shanghai premiums to soar without an immediate correction. The result is a disconnect between paper and physical markets, creating a pressure cooker that can explode at any moment. Now, overlay industrial demand. Silver is not like other commodities that can be paused or substituted. In solar panels, silver is an essential conductor. In electronics, it ensures reliability. In medical devices, it is often irreplaceable. Industrial users are non-negotiable buyers. They cannot wait for futures markets to adjust. They need metal now. That urgent consumption is compounding the scarcity problem. Each ounce absorbed in China reduces global availability and tightens the system further. Historical precedent underscores the importance of this moment. In 2011, silver prices spiked dramatically, but the signals were visible in physical markets long before paper prices surged. Premiums in key industrial hubs began rising, delivery delays appeared, and inventories thinned. Yet, many investors ignored these indicators because COMEX and LME prices were not yet moving. By the time futures markets caught up, much of the early opportunity had vanished. The lesson is clear. Physical stress precedes paper repricing. Another factor is inventory behavior. Above-ground silver stockpiles, which once smoothed fluctuations, are now drawn down faster than replenishment can occur. Mines cannot suddenly increase output because most silver is a byproduct of other metals, like copper, zinc, or lead. That means even if prices rise sharply, supply remains constrained in the short term. This structural limitation is why physical premiums are more reliable indicators than futures prices when predicting a squeeze. Let's examine the role of banks and bullion dealers in more detail. Under normal circumstances, they are the stabilizers. They facilitate delivery, smooth price differences, and ensure liquidity. But under extreme stress, they become part of the problem. Short positions that are manageable in normal markets suddenly carry massive risk. Delivery obligations escalate, and operational constraints amplify pressure. In a tightly stretched market, banks may even ration metal or prioritize certain clients, intensifying the squeeze for others. Geopolitical factors also amplify the risk. China has become increasingly strategic in its commodity acquisitions. The yuan, bilateral trade agreements, and internal policies influence how silver is sourced and allocated. When Chinese entities are willing to pay large premiums, they are often doing so to secure uninterrupted supply. This behavior further reduces the metal available to international markets, creating additional stress and widening the gap between physical and paper pricing. Premiums are more than numbers. They are leading indicators. Each incremental dollar of premium signals that buyers are struggling to secure supply. Over time, these premiums accumulate, creating a clear map of tension within the market. For a sophisticated investor, observing these premiums provides insight into stress points before they manifest in futures prices. Now, consider the feedback loop created by market psychology. As premiums rise, speculators may reduce exposure, hedgers adjust positions, and investors begin reallocating capital. This collective behavior amplifies pressure, often resulting in sudden and sharp movements. The key is that the movement is not caused by sentiment alone. It is the market's response to tangible structural stress. When physical scarcity intersects with leverage, the resulting repricing is typically violent. Industrial demand also interacts with broader market flows. Solar energy, electronics, and medical industries are consuming metal at rates that are large relative to mined output. Factories cannot pause, and industrial requirements do not diminish with higher prices. They adapt in other ways, often by paying more to secure the necessary supply. This relentless consumption contributes to premium explosions and underscores the importance of monitoring physical demand alongside financial signals. Historical comparisons reinforce this understanding. Look at palladium in 2020. Limited supply, rising industrial demand, and strategic stockpiling led to a period of extraordinary volatility. Prices surged, but the precursor was visible in physical supply stress. Similarly, the 2011 silver rally was preceded by rising premiums, thinning inventories, and delivery delays that went unnoticed by many until prices had already moved dramatically. The current Shanghai premium mirrors these earlier stress indicators, suggesting that the system is under similar strain. Another dimension to consider is currency dynamics. Silver trade in China often occurs in yuan or through bilateral agreements, which complicates traditional arbitrage. Fluctuations in currency and trade settlement mechanisms influence how easily silver can move internationally. When physical metal is constrained and arbitrage opportunities shrink, premiums diverge further. This explains why Shanghai silver is trading so far above global spot prices. It is the purest reflection of scarcity, unaffected by paper market distortions. Investors need to recognize the asymmetry in this environment. Market moves are nonlinear. Small structural disruptions can translate into large price responses. The combination of physical scarcity, leverage positions, and industrial urgency creates a system highly sensitive to stress. A minor delay in delivery or an incremental draw on inventory can cascade into dramatic price adjustments. To summarize the lessons from Part 2, the silver market is being shaped by four intersecting forces: extreme physical demand in China, structural inventory limitations, arbitrage friction, and leveraged paper positioning. Each factor alone would create tension, but together they amplify one another. Premiums are the most reliable gauge of this stress because they reflect real-time competition for physical metal, not expectations or speculation. As we move forward, it's crucial to continue monitoring these forces. Physical flows, premium trends, inventory levels, and industrial consumption are the leading indicators that will signal the next phase of market repricing. Understanding these dynamics provides a strategic edge for anticipating movements before they are reflected in paper markets, allowing intelligent investors to position themselves effectively for a potential squeeze. Continuing from our discussion of premiums, arbitrage, and industrial demand, it's essential to understand the historical context of silver squeezes because history tends to rhyme, especially in structurally stressed markets. Let's look back at 2011, which remains one of the most instructive examples. Back then, silver was trading around $30 to $35 an ounce for years, and supply seemed plentiful on the surface. But subtle shifts in physical demand began to strain the system. Coin sales surged, industrial usage increased, and above-ground inventories quietly declined. Paper markets were stable, so casual investors ignored the early warning signs. By the time silver exploded to nearly $50 an ounce, the move appeared sudden, but it was actually the culmination of months of invisible pressure. The lesson is clear. Premium signals and physical stress precede dramatic market moves. What we are seeing in China today is similar, but amplified. Shanghai premiums at $80 are not simply spikes. They are indicators that industrial users and strategic buyers are absorbing metal faster than the system can replenish it. When you layer in logistical bottlenecks and broken arbitrage pathways, the market is sitting on a structural time bomb. Global supply chains play a central role in this story. Most silver is produced as a byproduct of mining copper, zinc, and lead. This means silver output is largely dependent on other industries, which limits its responsiveness to price signals. Even if silver jumps to $90 or $100, mines cannot instantly increase output. Refining capacity also imposes constraints. The metal must be processed, transported, and verified before it can reach end users. Each stage adds friction. When demand spikes in China or any industrial hub, the bottlenecks amplify premium explosions. Let's also consider industrial consumption in detail. Solar panels are one of the largest consumers of silver, and demand is only accelerating. Global energy initiatives are pushing solar production to new heights, and each panel requires precise quantities of silver. Electronics, particularly smartphones and high-end devices, continue to absorb large amounts of silver. Medical devices and emerging technologies like 5G components and IoT devices increasingly rely on silver's conductive properties. These industrial pressures are inelastic. Factories cannot pause production simply because prices rise, which is why premiums surge before paper markets adjust. Meanwhile, investment demand is quietly returning. In previous cycles, retail investors and institutional funds have entered the silver market only after major price moves occurred. But now, there's evidence of accumulated positions in ETFs, physical coins, and bars that have been quietly absorbing supply. When investment demand intersects with industrial scarcity, the system's sensitivity increases dramatically. A relatively small draw on inventory can ripple through markets, triggering price acceleration. History provides further validation. Palladium experienced similar dynamics in 2020. Tight supply, rising industrial demand, and strategic stockpiling led to a volatile market environment. Prices surged sharply, but those who monitored physical flows, premium levels, and delivery times recognized the signs before the mainstream noticed. Silver today is showing identical warning signs. Premiums are spiking, inventories are tight, arbitrage is constrained, and industrial demand is non-negotiable. Let's examine the role of banks and bullion dealers more closely. In normal conditions, they act as stabilizers. They facilitate delivery, smooth out differences between markets, and provide liquidity. But under extreme stress, these institutions can amplify pressure. Short positions turn into liabilities, delivery obligations become urgent, and risk management shifts from profit optimization to system preservation. When multiple institutions face the same stress simultaneously, it can compound market pressure, leading to rapid repricing. Currency and geopolitical factors also play a significant role. China often trades silver in yuan or through bilateral arrangements, which limits the effectiveness of global arbitrage. Fluctuations in the yuan, trade restrictions, and strategic stockpiling influence how much metal is available for international markets. When premium pressures rise in Shanghai, it often signals scarcity that cannot be arbitraged away, further widening the gap between physical and paper markets. From an investor's perspective, this is crucial. Market moves are nonlinear. Small structural stresses, delayed shipments, slight inventory draws, or incremental increases in industrial demand can create outsized price responses. When physical scarcity meets leveraged positions, the impact is exponential. A seemingly modest reduction in available metal can cascade into large market moves that appear sudden but are entirely predictable to those who analyze physical flows, supply chain constraints, and structural leverage. Risk management in this environment is different from traditional markets. Investors must monitor multiple dimensions: physical inventory trends, premium levels, industrial consumption rates, delivery times, and logistical constraints. Paper market signals alone are insufficient. Sophisticated market participants understand that observing these structural indicators provides an early warning system for potential squeezes. The psychological component also magnifies market reactions. Rising premiums create feedback loops, hedgers adjust positions, speculators reduce exposure, and investors reallocate capital. Each behavioral response amplifies initial pressure. The movement we eventually see in futures prices is not caused solely by sentiment. It is the market responding to tangible structural stress. When these forces align, the result is often dramatic, fast, and difficult to anticipate for those relying solely on charts or headlines. It's also worth considering the interaction between industrial and investment demand. Industrial consumption absorbs real metal, removing it from the system. Investment demand adds pressure to already tight supply. Unlike other markets, silver's dual role as an industrial and monetary metal means it reacts sharply when stress builds. Both sides of demand can activate simultaneously, compounding the effects of scarcity and leading to rapid repricing. Global arbitrage remains an important factor, but is currently constrained. Normally, price disparities are smoothed by moving metal from regions of low to high prices. However, Logistical bottlenecks, regulatory friction, and strategic stockpiling have introduced delays that prevent these flows. When arbitrage fails, premiums explode, paper markets lag, and structural stress is exposed. This is exactly what we are observing in China today. Finally, the key takeaway from this part is that silver's current situation is not a temporary anomaly. It is a structural event driven by multiple forces: physical scarcity, industrial demand, premium explosions, arbitrage breakdowns, currency factors, and leverage positioning. Each of these factors alone would create tension, but together they create a highly sensitive system. The market's response to this tension will be nonlinear, accelerated, and potentially dramatic. For intelligent investors, the lesson is clear. Pay attention to physical flows, premiums, inventories, industrial demand, and delivery times. These indicators provide far more insight than futures prices alone. The $80 premium in Shanghai is a signal, not noise. It tells a story of structural stress, scarcity, and impending repricing that is visible to those who understand the underlying mechanics of the market. As we reach the final part of this deep dive into the $80 silver premium in China, it's crucial to understand the potential scenarios, risks, and strategies for intelligent investors. The market is under structural tension, and knowing what could happen next requires examining multiple layers of the system. First, consider the potential market outcomes. There are essentially three broad scenarios: gradual repricing, sudden squeeze, or prolonged divergence between paper and physical markets. Each carries different implications. A gradual repricing would involve futures markets slowly catching up to physical reality. Premiums might moderate slightly as arbitrage adjusts, inventories stabilize, and logistical bottlenecks ease. In this scenario, price movements in global futures would be noticeable but measured, allowing investors to reposition themselves methodically. However, this is the least likely scenario because current indicators show stress at multiple structural levels. Shanghai premiums remain extremely high, inventory depletion continues, and industrial demand is non-negotiable. Gradual repricing requires the market to have slack that simply does not exist today. The second scenario is a sudden squeeze, which is historically more common in silver markets under physical stress. In this case, physical scarcity intersects with leveraged paper positions, arbitrage breakdowns, and investor psychology to trigger rapid repricing. Prices could gap higher in a short period, causing large moves across both paper and physical markets. Investors positioned ahead of the move would benefit, while those caught off guard may face significant losses or missed opportunities. The current Shanghai premiums, delivery delays, and inventory trends suggest that a squeeze is not only possible, but increasingly probable if the structural stress continues. The third scenario is prolonged divergence. Here, physical and paper markets decouple, with Shanghai premiums remaining elevated while COMEX or other futures markets lag. This situation can persist temporarily, particularly if logistical, regulatory, or geopolitical constraints prevent arbitrage. Such divergence is difficult for investors to navigate because paper prices appear stable while physical scarcity intensifies. This creates an asymmetric environment. Those monitoring physical flows gain an informational advantage, while those relying solely on conventional price charts remain misinformed. Now, let's break down the risks. The first risk is physical availability. Investors who underestimate the speed at which industrial demand and strategic buying absorb metal can be caught in supply constraints, making it difficult to acquire silver at expected prices. The second risk is leverage exposure. Paper markets amplify structural pressure. Positions that seem safe under normal conditions can become volatile when scarcity intensifies. Third is geopolitical or currency disruption. China's role in silver markets is strategic, and fluctuations in the yuan, trade policies, or regulations can limit global access to metal, exacerbating premiums and price divergence. Understanding these risks allows intelligent investors to plan for multiple contingencies. A prudent strategy involves monitoring physical flows, Shanghai premiums, inventory reports, industrial consumption rates, and delivery times, rather than relying solely on futures charts. Knowledge of structural stress provides a leading indicator of potential price action, enabling proactive positioning. Investors who integrate physical and paper analysis, supply chain monitoring, and geopolitical awareness will be far better equipped to navigate volatile periods. Positioning strategies in this environment can vary. Those seeking exposure to physical scarcity may focus on acquiring coins, bars, or ETFs backed by actual metal, prioritizing liquidity and security. Those more comfortable with paper markets should monitor margin requirements, delivery schedules, and arbitrage conditions, ensuring that positions are aligned with both physical supply and market stress indicators. Diversification across physical and paper exposure can also mitigate risks associated with delivery delays or structural bottlenecks. Historical examples reinforce this approach. During the 2011 silver rally, early entrants who monitored physical demand, premiums, and delivery times gained significant advantage over those who reacted solely to futures charts. Palladium in 2020 followed a similar pattern. Monitoring physical scarcity and supply chain stress provided predictive insight that preceded extreme price movements. The $80 premium in Shanghai today mirrors these historical stress indicators, offering a rare opportunity to understand market tension before it fully manifests in paper prices. Timing is also crucial. Silver is highly sensitive to structural stress. Minor delays, incremental draws on inventory, or surges in industrial demand can trigger outsized moves. The system behaves non-linearly. Small structural changes can generate amplified price responses. Recognizing this sensitivity allows investors to anticipate movements and position themselves ahead of major repricing events. Another consideration is psychological behavior. Rising premiums and visible scarcity influence market participants' behavior. Hedgers adjust risk, speculators reduce exposure, and investors reallocate capital, amplifying structural pressure. Market reactions often appear sudden, but in reality, they are the culmination of multiple layers of stress accumulating over weeks or months. Those attuned to physical signals see the buildup. Those relying on surface-level metrics are often caught by surprise. Strategically, monitoring physical flows and premiums offers a unique advantage. When Shanghai premiums remain elevated while paper markets lag, it indicates that physical demand is outstripping available supply. This insight allows intelligent investors to anticipate repricing events, manage leverage exposure, and optimize positioning. Combining physical monitoring with traditional analysis provides a multidimensional perspective, enhancing decision-making in a structurally stressed market. Looking forward, silver's environment is unlikely to normalize quickly. Industrial demand continues to rise. Above-ground stocks are limited, and arbitrage friction persists. The market is under persistent structural stress. Investors who recognize the interplay of physical scarcity, premium behavior, and supply chain limitations can make informed decisions, anticipating market repricing rather than reacting to it. In conclusion, the $80 silver premium in China is more than a number. It is a signal. It reflects structural stress across physical supply, industrial consumption, arbitrage mechanisms, and investor behavior. The current environment mirrors historical scenarios where physical scarcity preceded explosive price movements. Understanding these dynamics provides a predictive edge. Monitoring premiums, inventories, delivery times, and industrial demand allows intelligent investors to anticipate market behavior, manage risk, and optimize positioning. This is a rare opportunity to study a market in tension before it fully manifests in paper prices. The signals are visible to those willing to analyze physical stress, industrial necessity, and systemic leverage. The combination of strategic observation, proactive positioning, and risk management can position investors to navigate one of the most structurally significant moments in silver markets in years. As we close this discussion, remember, markets are not random. They are the sum of structural pressures, human behavior, and systemic constraints. The $80 premium in China is the market speaking in clear, observable terms. For those who choose to listen and act intelligently, this is not just an opportunity. It is a lesson in understanding how real scarcity drives market behavior and how preparation can create advantage in the face of rapid repricing. The silver market is under tension. Physical demand is relentless. Premiums are surging. Supply chains are constrained, arbitrage is failing, and leverage amplifies the potential for sudden, dramatic price action. For intelligent, observant investors, this is a signal. The market is building to a point of resolution. The question is not if it will move, but how fast and how large the repricing will be. By integrating physical monitoring, industrial analysis, historical precedent, and systemic understanding, investors can position themselves to navigate volatility with clarity and insight. The time to watch, analyze, and prepare is now. Because once the market reconciles physical scarcity with paper pricing, the moves may be rapid, decisive, and consequential for anyone not paying attention.